Hi everyone, and welcome to today's webinar. We're going to be talking today about the current startup ecosystem and how founders can succeed within it. My name is Jill McKnight. I'm a practice group leader in the corporate transactions team here at LegalVision. I specialize in capital raising, so I do everything from equity deals to convertibles like safes and convertible notes, all the way to through to straight debt, so quite a broad range of experience. LegalVision itself is a startup as well, also worth noting. So we have been through all of the issues that you yourselves are facing and are very well placed to advise upon them. I'm joined today by the fabulous Tom Humphrey, who has had a haircut especially for today, and he is a a partner at Blackbird Ventures. Blackbird obviously needs no introduction. It is one of, if not the biggest and best VCs in Australia, and Tom as well. Most of you will know him, as well as being a partner at Blackbird, so being well versed in what VCs are looking for in startups and founders themselves. He also used to be involved in startups himself, so I believe you worked for some startups and then you also founded one yourself, Tom, is that correct?
Yes. Yep.
Yeah, so really well placed to speak today to us about what makes startups great and what founders can do to help them succeed. So just before we start, there are a few quick housekeeping things to go through. So at the end of the webinar, you will receive a recording, so you can watch it over and over again if you like. You'll receive it via email. At the end, we'll be doing a Q&A, so please do submit your questions in the question box and they will be fed through to us and we'll try and answer as many as we can. And finally, there is a feedback survey at the end of the webinar, so please do take the time to fill it in because it's really valuable to us to see what you did like, what you didn't like, what we can do to improve, and also any topics that you'd like to see us cover in the future, because obviously we want to help you as much as possible. So please do give us some feedback at the end. And finally, you can also claim a free consultation with one of our lawyers. I believe you just need to leave your contact details in the survey that appears at the end of the webinar. So do take advantage of that. It's a really good opportunity, and that's probably my first tip. Never turn down free advice. So yeah, do sign up to speak to one of our lawyers about any burning issues you have, particularly any that we don't get through today or that you come up with after the webinar. All right, so moving on. So I'm going to let Tom do most of the talking today, because he's so uniquely placed to speak on this topic, but also I've just had some braces fitted on my bottom teeth, so they're a little sore and I'm finding it hard to speak clearly. So we're going to start off by looking at sort of the current ecosystem and how things are changing, maybe what next year looks like, and then move on to how founders can succeed in the current ecosystem, and also some common mistakes founders make and tips to avoid them. Okay, so first of all, Tom, what trends have you been seeing in the Australian startup scene over the past sort of 12 months or so? What really stands out?
Awesome. Yeah, look, it's a really great question. I'm excited to reflect on that and excited to be here. Thanks for hosting and having me today. Look, to frame the last 12 months, I think it's important to frame maybe the last decade. I was in Australia back in 2012. I actually jumped into the startup scene back in 2010 when I joined a pretty fast growing tech startup in Sydney. It was called Outbound. It was kind of like the Groupon type model. And that grew incredibly fast in the space of about 12 months, grew from founding to about 85 people and exited to News Corp. And, at that time, operating in the ecosystem, it was a very nascent ecosystem. Like I'd talk to my friends at dinner parties and they'd say, what's a startup? And I'm like, I don't really know myself. And there was no VCs around. There was no Blackbird certainly, or any of the other VCs that you might know today. And there was really no sort of like flagship companies to point to as success stories from Australia. There was no Atlassian, there was no Canva, like these were like early or not even founded yet at that time. And I actually left Australia in 2011, went to the US, went into San Francisco, right into the heart of the ecosystem there, and was just like spellbounded by what was there. Like, you know, I was living in Soma and I could see Airbnb and Uber, and it was all just happening in that time period. And it was just incredible to see that. And then returning to Australia in 2021, I didn't even recognize the ecosystem here. Like, it's just like, it's blossomed. We've got these amazing companies that have become global winners, like your Xero in New Zealand, or your Rocket Lab, your Atlassian, Canva here, Afterpay, all of these companies which are amazing. You've got a thriving VC ecosystem, and you've got talent in the ecosystem. You know, almost a million people now work in the tech industry, which for a country of 26 million is amazing. So that's kind of like framing the last decade. Now, to kind of like frame the last 12 months, like it's been a really interesting time to be in venture. I'd say, you know, the first thing I'd say is like it has been a normalization of the ecosystem. It's not like, I think like it's important to frame 2020, 21 as sort of like abnormal situations where things got overheated. And if you just look if you just look at the public markets, like that's the obvious thing to look at. You know, we saw some like revenue multiples that just went completely out of whack with anything we've seen in the history of the markets, and they've normalized back, and that's kind of fed into the startup ecosystem too in the private markets, where, you know, there's a normalizations of funding rounds, there's a normalizations of valuations, and you know, and so we're operating in that ecosystem which is a little bit more normalized, which frankly is a good thing. But you know, some of these companies which are probably really grappling with that are the ones which had maybe raised at peak valuations in that period and are maybe having to adjust their expectations for where things are out in the new market. But the other thing I'd say is like we always talk about where we are today in the Australian ecosystem. We're entering generation 3 of Australian startups. You know, if you imagine like a family tree and you start with the grandparents up top and there's 2 of them, and then you get down to the kind of parents who are the kids, and there's like 10 of them, and then you go to the grandkids and suddenly there's 100 of them, like when you get to the grandkids. And that's kind of what we're seeing in the Australian ecosystem. You start at the top with like your Canva, your Koala on the consumer side, your Atlassian, and then we saw a generation 2 of startups, which I would really say define like the last 5 years as generation 2. And so you can see these sort of parents which are popping out from these grandparents. So you've got Dovetail, which is like ex-Atlassian founders. You've got Eucalyptus, who's ex-Koala. And then I'd say like in 2023, we're now on generation 3, and it is an incredibly exciting time. You know, just even in our portfolio, you can see like Magic Brief popping out of Eucalyptus. It's like the generation 2 companies are training these founders that are now the next generation of founders, and it's a force multiplier. And so the volume of founders and companies getting founded today is a force multiplier like we've never seen before in previous generations. And the quality of these founders is also incredibly high too, just given they've had this training at these best-in-class kind of companies like Canva and Atlassian, and so they've just got these incredible skills to take on the world. So it's a really, really exciting time, but also like obviously just in terms of markets, like a normalization of the market and kind of getting to terms with that.
Yeah, that's a really interesting perspective, actually, the Christmas tree idea you had with the, you know, the companies sort of supporting the companies below and bringing on the founders below and that kind of thing, because you do see that a lot. And you also now are starting to see founders investing in companies as well, which is also a really interesting new thing, I think. So they're sort of supporting the people that spring off from their companies as well, which is great.
Yeah, and we love that. Like I often, you know, when I'm leading an investment round into a company, especially at the earlier stages where it's, you know, I always call it like, it's like building a village around a startup. Like, you know, the more people you can kind of bring around to support and help grow this, you got this little seedling, and it's just like, it's very fragile, and we've just got to all get around it and water it and, you know, give it the right soil. And so, yeah, like oftentimes, you know, when we are kind of like investing in a company at that point, we carve out a certain allocation just to kind of support, like, hey, like, let's get these angels or other people involved that you think would be really helpful to kind of build the business and provide operational support. So it's a really great thing.
Yeah, no, I agree. Yeah. So in terms of the market right now, how do you see that? Do you think it's still sort of in that sort of stabilization phase? Do you think things are starting to change, or what are your thoughts on right now?
Well, I think my head of compliance will ensure that the first thing I say here is that this is not financial advice, but
Yes. Absolutely not.
However, look, it's hard not to think that we are sort of, stabilizing, and it's sort of, I can't see us going any lower from here. Like, I think we have hit the bottom, and, we will be starting to kind of see the market kick in. If you look at the last year, I'd say, look, the seed, pre-seed round, like early stage, like we haven't seen a heartbeat really skipped. Like, I'd say maybe some of the valuations of seed rounds have tempered a little bit. Like, what was a $20 million valuation might now be a 15 mil valuation, but deals are still getting done at the same pace. Where it's been really kind of hit harder and has been a lot slower is at the later stage. And the main reason for that has just been like, it's really difficult as a startup if you've raised at a $1 billion valuation on 100x multiple. Suddenly the market has moderated and multiples are down at 10x. For you to kind of raise your next funding round, you either have to moderate your expectations and maybe you do a flat or down round, or you push it back and just try to keep growing the company so you grow into that valuation. And so because of that, we've seen a big slowdown in the later stage activity. And just looking at public markets, the IPO market has been crickets, right? So I think we're starting to see the signals of that kicking back in, and part of that will be companies just at some point have to raise, and whether it's runway or needing to keep funding operations. But also I think some of these companies have had that extra year or two to kind of grow and keep growing, and are starting to kind of grow into the valuations which they had set. And so I think we will start seeing a lot more rounds happening, and they might be slightly up or maybe even flat rounds, which is fine. But that's likely what we're seeing. I think it's important as well to say, like, it's funny because like it's really easy to get obsessed with the market, and like you can constantly look at the public markets and what evaluation's doing, and my comp is Twilio and what's happening there, and it's really easy to get obsessed with that. But I think it's really important just to kind of we always say at Blackbird, the market is like it's like when you're doing a startup, it's like you're racing the Monte Carlo Grand Prix, and you're racing around the racetrack, and you're a startup founder and things are crazy, and you're racing as fast as you can, 300 kilometers an hour. And if it's sunny, you just go really fast, you take the corners really, really well and hard. But if it starts sprinkling with rain, you're still on the same racetrack and you're still racing around the track, but you might just moderate how quickly you go around the corners. And that's exactly like how we kind of think about it in startup land. Like this is like a wet weather situation where the markets have kind of dropped, and customer appetite for acquiring new products might have slowed, and you've just got to kind of take the corners a little bit slower. Like you might sort of like slow down your kind of hiring of new talent and kind of moderate, try to extend your runway, and that's fine. But you're still competing in the same race, you're still on the same racetrack, you're still building the same product for the same customer use case. It's just like you might just moderate how hard you take those turns.
Yeah, I would certainly agree with your comments about the later stage rounds. And I think what we've been seeing is with those companies that are later stage, where they need money, they tend to be going back to their current backers for more money. They're not getting it from new VCs. And often it is at the same share price. Sometimes safes or convertible notes will convert at a lower price, bringing in the down round element as well. We haven't seen too many where the share price itself of the new round is down, but certainly the convertibles can bring it down. And I'd say we've been seeing a lot more safes as well, and also convertible notes than we'd seen previously. And some of the convertible notes as well have been secured, which is quite a new thing. And sometimes we're seeing sort of companies that do one convertible followed by another convertible followed by another, and they're literally just trying to push out the time at which they have to do a valuation of the company, and so that they're hoping that eventually they'll be able to get a much higher valuation again when the markets pick up. Now whether that happens or not, I don't know, but we've certainly been seeing that quite a lot.
Yeah, and definitely see that. I think the two things I would say to that, one is that, you know, companies are still raising, and like the high quality, like there is almost sort of like this flight to quality. And, you know, if you do have sort of best in class like metrics around your unit economics and your growth rates, I'm talking specifically for venture here, like, you know, private equity and other markets are completely different. But, you know, specifically for venture, if you do have like quality metrics, like you get deals done. And there are very high profile deals that are in the public media right now that you can see at the later stages that are getting done, whether that's Canva, Employment Heroes, Safety Culture, and none of these are down rounds that are happening. They're either flat or up. And so deals are getting done, but you know, you have to like be really like have the right metrics. And if you don't have the right metrics, then that can kind of be something where you might just be wanting to kind of temper your expectations. I'd also, as a secondary thing, say, look, there's this element of like controlling your own destiny. And I think, you know, looking at my portfolio, like especially the ones who have a longer runway or like a comfortable, like they're in it, when you got a like, really strong position, it just means like you can control your own destiny. And so like you can either kind of push back the fundraising situation. The worst, vis-a-vis the worst scenario is when you're against the ropes, you're running out of runway, you've got, you know, 3 months, and then you got to kind of, you're out of cash, and you know, then you're kind of against the ropes, and it can be a really difficult situation, and you're kind of then forced to kind of take what you can get. And so my only counsel here is just like trying to kind of try to extend your runway to control your own destiny, so that you can kind of, when you do have these conversations with investors, whoever they might be, you're coming at it from a position of strength.
Yeah, for sure. Just quickly, this is a really hard one, but do you have any predictions for next year in terms of the market?
I hesitate to make predictions because all my past predictions have been completely wrong, but I'd say, look, I mean, like we've talked about it a little bit, but I would say I expect the later stage kind of market to kick in. I expect that we will be seeing some interesting activity in the IPO market on the public markets. I expect in the private markets, we'll start to see later stage kicking back in. As I mentioned as well, I think early stage investing is just going to keep going as it is. Like it's, you know, pre-seed seed investing in Australia right now, like nothing has changed versus previous years, and it's just humming away.
Yeah,
deals are getting
a huge amount of deals, pre-seed, seed, lot, and seed as well.
And especially in venture, like the biggest signal for, I guess, one big predicator of like what's to come is that there is plenty of dry capital in the market. There's a lot of venture capital which is out there both locally and with foreign investors that are interested in this market and do invest in this market. And so that is a signal that there's capital that's, you know, hoping to be put to work. The only thing I will say that is I do think the element of caution that is in the market with investors or others will linger for a few years. I think that there has been a jolt to the system, you know, and the market drop has kind of kicked, you know, the wind out of a few folks in terms of, you know, their sales. And so I think like there's this element of caution. And so I don't see like necessarily, you know, things kind of in terms of the speed of capital deployment or, you know, what investors are looking for in terms of, you know, higher expectations in terms of the metrics, et cetera, for the business, that will probably stay for a little while. My only other prediction outside of, you know, the funding markets would probably be an interesting one. It's around deep tech. I saw an article in a newsletter called The Capital Brief, which just came out, I think it was yesterday, and it was kind of foreshadowing just like where deep tech is in Australia. And it really resonated with me. I think, I don't know whether everybody knows this on the call, but like Australia's got a really rich history of deep tech. You know, we invented Wi-Fi in Australia. Google Maps was invented in Australia. Modern solar panels invented in Australia. The Hills Hoist. You know, we've got really good research institutions in Australia, and they actually do a lot of really good R&D. And I think we're now sort of starting to see the early signals of you know, these commercialization pathways of that R&D which happens at universities, this research getting kind of spun out into a startup and commercialized in a structure that is going to work for a startup structure. And we're also seeing a lot of like early stage programs. Like at Blackbird, we have a program called Foundry, which is all about fostering that commercialization pathway too. So I think one prediction I'd say in the next year is I think that we're going to see some really good activity in the deep tech market. Australia's really well positioned for certain markets like quantum and space and climate tech, and I think we're going to see some really interesting activity there.
Yeah, fantastic. Now you mentioned there that there's a lot of capital to be deployed, which is absolutely right. There are a huge number of VCs now in Australia and overseas, as you mentioned, and we see, you know, a lot of news about how much capital these VCs are raising themselves that obviously they need to deploy. So moving on now, how can a founder make sure that their startup is one of the startups that the VCs will invest in? What are your top tips on what founders can do?
I'm going to take the question because I actually think that's the wrong goal. You know, I think that if you are a startup founder, you should not be building your startup to get investment. You should be building your startup to build something which is beautiful and growing for your customers. And I think, you know, that's the first really important message I think to send, is that the most successful companies out there don't even really think too much about the investor side of things. Like that's the afterthought, and the investors kind of come chasing you when you build an awesome product. And I think it's really important as a founder to have that focus. You know, Jeff Bezos always, you know, Jeff Bezos gave this quote and he always kind of spoke about this, and I really love it. It's like, when you are building a company, you need to be customer obsessed and competitor aware. And I think that's a really important message. And I'd kind of maybe expand that and say customer obsessed and competitor, and maybe investor aware too. Like, you know, you should be just really focused on your customers, just like in their faces, design customers, learning from them, understanding your churn, understanding your growth, you know, the customers that are really working and loving your product, like why are they loving it, and just building that customer love and just building a product that is well loved. And if you achieve that goal of building a product that is well loved by customers, like everything else falls into place. You have revenue falling into place because your customers buy the product because it's a great product. You have investors chasing you because you're growing, and they can kind of see the customer love in your metrics, and they can see your revenue growing. And so if you focus on that one goal, like everything else tends to fall in place. So that's the first thing I'd say. The other kind of things I'd mention, and look, this is just, you know, I don't mean to be on a high horse as a VC, but I did spend 8 years building 2 startups and have been in those trenches, and I know how difficult it is. My only sort of advice coming from that sense of emotional empathy for every founder out there is just, you know, you need to, like, 2 things. One, emotional regulation. It is an absolute emotional roller coaster being on a startup. And I think, you know, I always say, like, when you're in a normal job, like as an accountant or a lawyer or whoever you might be, like, you have your up days and your down days. Like, you always have up days and down days, and, you know, your up days are here and your down days are here. But when you do a startup, it's like a 10x magnitude of the ups and downs. Like, you know, an up of like landing your first customer just feels, it's like the most intoxicating kind of, you know, dopamine hit that you can have, and it's just amazing. But then you have these downs, like, oh, you're just star employee, just quit, and they just kind of hit you so hard, and you kind of like go into a dark place. And you just got to be able to kind of regulate those emotions as best you can. And I think to do that, it's, you know, helpful to surround yourself with mentors and advisors who can kind of really help you with that. And then the second thing I'd say is, I love this concept of the athletic mindset, and it's the idea that founders are athletes. And if you're an athlete and you're training for the Olympics, you have to, you know, train every day, and you have like a holistic regimen, which is not just about like, oh, I'm going to go run on the race, you know, the running track every day. It's about your health, your diet, you know, how you report things and log your kind of races, and you've got to reflect on things, and you've got to kind of meditate and maintain focus in your physical kind of and psychological routine. And I think it's exactly the same for founders. Like, you are kind of entering onto the Grand Prix at Monte Carlo racetrack, so to speak, and it is really important to kind of have that kind of mindset that you are an athlete, and that everything you do, whether it's your diet or emotional regulation, is part of the equation to success. And so that's the only other piece of advice I'd give as well.
Yeah, that's really good advice. Very excellent. Okay, moving on to some of the key mistakes that you have seen founders make, and maybe some tips to try and avoid them.
Yeah, look, I'd say, you know, I'd also frame these as things that, you know, on the alternative side of the things that go right. So the first kind of category would be around people and team members, you know, and I say this as like, sometimes I see the mistake of, you know, people picking the wrong co-founder or the wrong people in senior leadership positions. And, you know, sometimes those decisions are very reversible. So like, you hire someone and then they move on, but, you know, your co-founder is someone who can be really difficult to obviously, you know, get away from that decision. So I just kind of say, look, just be really cautious about, some of the decisions you make are on the people side. I think like just kind of taking a step back, there's this framework I think this is actually Amazon as well, Jeff Bezos, but it's like the concept of the doors you can walk through and the doors that you can kind of walk back through. So like when you're making a decision, if it's a one-way door, like I walk through this decision and I can't turn back, like selecting a co-founder, like those are the ones that you really need to think about and make sure you make the right decision. If it's a decision that you can kind of walk through the door and then walk back out, as in like hiring an engineer, and you can always kind of like, move them on and then hire someone else, like those are ones that you can kind of make more quickly. So I think having that as a framework as a founder and just making sure that, when you are coming up to those decisions that are hard to walk back from, that you kind of really think about them and reflect on the decision. I'd also say like picking your investors, speaking as a VC. And look, I speak about that as someone who's been on the other side of the table twice. I did Audio, and then I did a company with my sister that co-founded in San Francisco, and we had 4 kind of venture capital firms, private equity firms that were investors across the board. And I just personally can just convey to you just the importance of those relationships, because I've had good ones and not so good ones. And the value of a good relationship is just worth its weight in gold. And then maybe the last thing
that it's worth sort of starting up your network, not just to potential VCs and investors, but also advisors, mentors, other founders as well. Well in advance, because you're always going to need to go to these people for for feedback. What if I'm doing this, what's your advice on this? You want to speak to founders who are in the same position as you and get their feedback, what they've been through, what worked for them, what didn't, but also getting to know investors as well. Are these people that you see you could work with, going forwards? Do you like them? Are they going to help you? Are they going to provide advice and input into the business, or beyond just money, if that's what you want? So that's a really good tip as well, I think, and starting those networks ASAP.
Yeah, absolutely. I definitely think that's worthwhile. I think it is important just to caveat that you don't want it to become a distraction. Like the most important thing here, as we said, was just like talking to customers and building a product that's loved. And if you spend too much time kind of like networking with investors, it can kind of be a distraction to that common goal. But so the caveat I'd say to that is just like you can kind of like do things that are scalable in terms of that goal of building those relationships with investors and networking. And what I mean by that is like two things. Like one is rather than kind of being spaghetti against the wall, scattergun in terms of the relationships you look to develop, like actually try to be like a little bit more thoughtful and targeted. So if you know that this investor over here is probably unlikely to be a good fit, in that you're a Series A stage company and they only invest pre-seed, well, probably not worth spending time there. Like try to focus your efforts on investors or founders that will be a good fit, and be more targeted with fewer relationships than scattergun. And then secondarily, like just doing things like doing a monthly kind of like, I guess, investor advisor update is a great thing. So we actually have like this template we give to all of our founders of just like, hey, like here's like an email template for a monthly update on the business, and it's sort of like the financial metrics, and then here's the key kind of wins, and it's sort of like what's going well, what's not going so well, what's the ugly, and then it's got the key asks like, hey, like here's where I could really need help. And so it's just this template, and it's actually incredibly great to do. And I'd say like the second reason for doing it is to kind of like keep these investors and advisors like up to date and asking for help and getting help from them. That's the secondary reason. I actually think that the bigger reason to do that is as a personal self-reflection. Like I think when you are doing a startup, it's really easy to get like weighed and bogged in all the weeds of everything going on, and just like you're getting pulled in every direction. And I think like this element of lifting your head up out of the water and actually having a forcing mechanism to reflect and put down in written form, like, hey, here's like the strategy and how we're going against our goals. Like it's actually a great reflection exercise. So that's another thing. And to this point about investors, like it's a scalable thing to kind of keep your investors updated on how things are going and keep in touch with them.
Yeah, I think the one you mentioned earlier as well, just about making sure you have enough runway ahead of you, and not falling into that trap of being desperate to raise money in such a way that you have to agree to terms that you wouldn't otherwise agree to. We've certainly seen, particularly recently, companies accept terms that are just not market standard. So for example, a 4 times liquidation preference, which is just ridiculous. And I think they just, were just so desperate they had to agree to it in the end. Otherwise, that would have been the end of the company. So just make sure you're organized and prepared well in advance and aren't running out of money. And also make sure you understand the terms, because a lot of the time, for example, they didn't really understand what that meant. So make sure you get a lawyer to have a look at the term sheet before you do sign, and often lawyers will look at a term sheet for free. So it's really worth doing that just to make sure that you do fully understand what you're signing up to. Okay, I think we're going to move on to the Q&A now. So I've got a few questions that have come through. So the first one, Tom, is it common for a startup to get into the pre-seed stage without any sales, but with a vision to disrupt the market and a prototype available?
100%, yes. I mean, easy answer. Yeah, look, I mean, to put it in context, I think in 2023 so far, 80% of the investments, like new company investments, excluding follow-ons, from Blackbird are into companies that are pre-revenue. So just to kind of put it in context, like that is businesses that don't even have a drop of revenue and oftentimes don't even have a product yet. We've done 2 in the last 2 to 3 months where it's a founder with an idea on the back of a napkin and they don't even have a technical co-founder yet. And so we're investing and saying, hey, like, let's help introduce you to technical people. So it's like the earliest possible stage of the idea. So absolutely, yes. I think the most important thing we're looking for at that pre-seed stage is, I'd say like really just 2 things. Like one is just like the founder, and it's just like, is this their life's work? Like, how did they come across this problem? Like, is this something where they really have learned to understood the customer need and have really well defined in a vivid way, like exactly the customer need, the pain point, the product that they need to build, and have like a really clear roadmap. So it's really sort of like around the founder and just like their vision and what they're building, and just like building belief in their ability to kind of execute on this over the many years ahead. And then the second thing will just be like around the opportunity. And I think, having like this really crystal kind of opportunity around here's the customer pain point, and it's like a really important pain point that's worth caring about. And, we're building a product here that has the opportunity to kind of build into something big, global, and meaningful in terms of revenue. So those are kind of like the 2 things we look at. And so, obviously, like if you've got early customer traction and revenue, that can be helpful to kind of build that conviction and belief, but it's not critical at all.
Yeah, and you mentioned earlier that startups, it's good if a startup has VCs chasing them. How often does that happen, that a VC actually approaches a startup?
Yeah, like, I mean, it happens a lot. Totally. Like it's like the way I'd frame it is like a venture capital firm is like any other company. We're a sales operation. Like I am right now, I'm a sales guy, and I have inbound and outbound leads. Like inbound leads are founders who might reach out on our website or reach out through a referral and say, hey, look, I'm raising around and I'm looking for venture capital. But we also have an outbound motion, and we kind of go out there looking for amazing people. And sometimes we're almost encouraging people to start companies where they're not even thinking about it. Like, I often will just kind of meet with people who are just like awesome operators at certain companies and just lay the seeds of like a relationship. And at some point, maybe in the next couple of years, they're thinking about doing a startup, and I'll be there to kind of ideate with them. There's one right now, actually, I've been kind of connecting with over the last month or so, and this is just like an awesome operator, got a lot of respect for, who's worked at companies that I know quite well, and he is just ideating on just like different ideas. And we've just been kind of meeting up and just like he'll present an idea and I'm like, nah, I hate it. Present another idea, oh, this one's interesting, like maybe go, it's just like, and it's often a case of like, look, we're not even ready, we haven't actually landed on the specific idea that you want to go after, but I'm here to kind of ideate with you. So yeah, so kind of classify that as like inbound, outbound. And so yes, sometimes it is about sort of outbounding and trying to go out there just to find amazing people and connect with them.
Amazing. Okay, there's lots of questions coming through. I'm going to sort of try and stick to the ones that are more better for Tom to answer, because those that are more legal, obviously you can call in and speak to us later. So as a founder, I'm looking for an investor who can provide influence, not just capital. does that work in a startup ecosystem?
Yeah, look, I mean, it kind of depends on what sort of influence you want. You know, like, you know, there's influence with customers. So, you know, there's lots of sort of investors out there, whether they're high net worth individuals or VC funds or corporate venture funds or otherwise, that are very well tapped into customer markets and can kind of help with, you know, customer influence. Like, hey, I've got this kind of you know, this bank of kind of people I know in the real estate industry or the construction industry or whatever it might be, that I can kind of help introduce you to kind of make potential customer introductions. You know, there's influence in terms of like future capital rounds. Like, hey, I've got a really good Rolodex of you know, VCs overseas or Series A investors, or you know, that might be the, you know, the kind of capital influence. So I'd say the first thing is like, what influence you're looking for is the kind of first question, and you know, then that will help identify where does that influence kind of come from. And then I'd also say, like, you know, there's different ways to kind of construct rounds. So as we mentioned before, you know, often when you're doing an early stage round, like there'll be multiple investors that kind of come to the table. So just to kind of give you a really hypothetical, like let's say you're a pre-seed and you've got an idea and we really like it and we're like, oh man, this is cool. Like we might sort of go, okay, like let's do a $2 million round on a $10 million post money. So 20% dilution to the investors, but you know, we'll give you 1.5 of that. So we'll carve out 500K and let's just go and find like all these amazing people to kind of come in and kind of contribute to that. And that could be like other VCs that might just chip in like 1 to 200K, or it might be like angel investors that chip in 10K. And you know, those angel investors, to your kind of question about influence, they might be ones who will bring that influence and complement that. And that often happens. I had a company which is in the DevOps category. They sell their product to developers. We did this exact strategy. We carved out 500K, and you know, they went off and got the CTO of Yelp, the CTO of Webflow, the CTO of SailPoint, the CTO of Envision, like all of these amazing people to come in as angel investors. And what a great result. Like they've got this great amount of capital. They've got a VC fund there to kind of like be like the steward of support and advice in terms of like, you know, helping them build the company and growing the team and all the kind of resources we provide. But then they've got, you know, these very specific people who are CTOs and effectively their customers with rich networks of other CTOs, and that's kind of helpful for them in terms of that influence of unlocking customers. So that, you know, there's different ways to craft for influence, if that makes sense.
Yeah, that's fantastic. Okay, next one. Can you provide a list of metrics we as founders should look for?
Love that question. It's a really hard one because there's lots of metrics, but I'm going to kind of like lift it up a level and just give you a really simple framework. I've got a 4-level framework for like how you should be thinking about the metrics which are important to your business based on what the goals of the metrics are meant to show you. So the first kind of element, number 1, is like for your size. And this is really important because the metrics we would expect to see for a company at $100 million ARR are very different for a company at 1 million ARR. So it's really important that metrics are put in the context of the size of your business. Okay, number 1. Number 2, we want to see you growing fast. So if you are at a $1 million kind of run rate, ideally you're kind of growing at that triple, double kind of growth rate. That's like a very common kind of you know, language used in venture capital of triple, double. The idea is you get to $1 million, then you triple, 3 million, triple, 9 million, then double, and you get to your $100 million run rate over the course of those 6 years. So that's kind of like the journey that you see like with the Canvas and some of these companies that are the hyper successful. Like obviously like that's not the majority of companies will follow that kind of growth journey. But the point being, as a venture capitalist, we want to see you growing as fast as possible. Like growth is important. So the metrics to show that you are growing, and that can be like metrics in the category of revenue, like, oh, like our revenue is growing 10% month on month, fantastic. It could be metrics in the sense of customers or activity, like even we don't have revenue yet, but we're seeing like crazy growth in activity and getting like 100,000 signups of customers every month. Like awesome. Like so growth is the first thing. The second, so for your size, growth. The second element is with customer love. So not only do we want to see you growing, but we want to see you growing with a product that is loved by those customers. The metrics which kind of show that customers love your product are basically that they're sticking around or growing with the product. So for example, low churn signals that the customers love you. If you've got all these customers signing up and they're churning really heavily, well, maybe they're not loving your product, versus low churn is good thing. NDR is a really good metric. That's net dollar retention. That factors for churn, but also expansion. So if you have a customer that comes in and starts paying you $100 a month, and then 6 months later, they're suddenly paying $1,000 a month, that shows that they love your product because they're expanding and giving you more money for the product. So that's a great signal. Another kind of thing of customer love is probably just in the usage data as well. Like, are they kind of growing, and you're seeing them inviting all of their team members along to join the product as well. And then the last thing I'd say is like around efficiency. So, this idea of like, you've got good unit economics, you've got a profit, like you might not be profitable now, but you've got a roadmap to profitability. So this is where we're looking at things around the efficiency of your sales business. So there's a metric of magic number. So it's just like, hey, every dollar that we spend on sales and marketing, how many dollars do we get back in revenue? And so if you're above a ratio of 1 to 1, that's great. And if you're low, then it's like saying, hey, we're spending all this money on sales and marketing, and we're not really getting much success back in terms of, revenue. Other kind of metrics there, like burn ratio, like how much are you burning as a company divided by your revenue gain. So, we want to kind of see you basically growing fast with customer love, with an efficient kind of business model, and like all the metrics really simply that we want to see just fit into that framework. So whatever metrics you choose, whether it's CAC payback, whether it's like NDR, whether it's growth rate, whatever, doesn't matter. We just want to see those 3 things.
Amazing.
For yourself.
So easy. We've got loads of really good questions here, but I think we've only really got time for one more, unfortunately. But this is a really good one. Should investors recognize the founder's need to retain a significant percentage to remain incentivized? I think that this is a really important one.
Could you say it again? Just frame the question again.
Yeah. So should investors recognize a founder's need to retain a significant percentage of the company to remain incentivized?
Yeah, look, I'd say, the answer to that question is yes. There have been, to kind of give you an example of where this becomes a problem, like historically to this kind of, we were talking about this maybe 20 minutes ago, the commercialization of R&D in Australia has been a really difficult problem because, when you have this research which happens at a university, and then you're like, oh, wow, this is like a business, like we can turn this kind of, this thing that we've invented at university, whether it's like a chemical or, a product or a solar panel or whatever, we can now spin this out and create a business and a startup around it. One of the biggest problems is like the university and trying to how do you separate that from the ownership interests that, the university owns this R&D and the IP. And so we've got to spin this out in a way that, okay, we've got to kind of create a equity cap table here that has the right structure for a startup, because otherwise it's really difficult to create a 10-year, 20-year journey of growth with the whole team and incentivizing the team. So other kind of situations where that might be a problem is when it's a spin out from a company, like a bigger company spinning out a division, they want to hold on to a chunk. Or so generally speaking, when you've just got a fresh, down the fairway kind of startup, usually they're kind of coming along and it's 1 or 2 people and they're like, hey, I've got this idea, and it's just a clean cap table, we haven't even set up a company yet, and you set it up and it's founders own 100%, you do your round 20% to the investors, and then off you go, and it's usually kind of clean. As to this question about well, what about over the 10-year journey of the startup, what happens from there? It kind of depends. If you go on this incredible journey of you're in the top 1% of success startups, then you can kind of control your own destiny, and your next valuation is going to be amazing, and you're probably going to take less dilution because you're the bow of the ball. If you're not on that journey, then you might be kind of struggling with the valuation, or maybe there's higher dilution at the next rounds or otherwise. Our goal as investors is to make sure that the founders, not just the founders, but the team members, are kind of incentivized and rewarded along the journey. And every time we do an investment round, we will do a top up of the ESOP pool. So you start off with a 10% ESOP, and so you set aside 10% of the company, and that 10% will sit there. And as you hire employees, we want every single employee in the organization, no matter their title, to get a piece of that ESOP, so that they are kind of part of the journey and feel like the success of this company, they own that success. And there is instances across the journey where things might get out of whack with founders, and then if that does happen, you just got to work with them to kind of maybe you do an ESOP top up for the founders, or figure that out. But typically those are the outlying situations. Generally speaking, on these journeys, the things kind of like work out and everyone's got the right incentives and the equity is significant enough for the founders. But there are situations where that might get out of whack, and you just got to work with the founders to sort that out.
Yeah, and you've just got to be careful, especially in early rounds, that you are working with reputable investors, I suppose. I know someone once told me about a specific company that ended up giving away 65% of the company in their first round, and obviously it's just not going to be investable after that, because as you've said, the founders don't have that incentive to stay engaged in the company because they've got such a small percentage already, and it's just going to keep.
Yeah, I mean, to put it in context, like we would 100% never invest in a company with that.
No.
Like we have never in our entire career done anything, that's like that. Yeah, I mean, like our kind of framework is like you come along and it's sort of like, typically there'll be like, the framework is, and you can kind of get the numbers of this of like average dilution at each stage, like all the data's out there, Carter or whoever, generally speaking, it's like this idea of like 20% dilution per round. So you start off, with a company, you raise a pre-seed round, 20% dilution, 80% to the founders. You do your seed round, there might be 20% dilution again, but everybody gets diluted, including the existing investors. And so, suddenly the 80% might go to like 70, 75%, and then, it kind of goes down by round, but you're also kind of building a big company, right? So, it's better to own 50% of something worth $1 billion than 80% of something that's worth $10 million, right? That hasn't even started yet. So, the idea is like, your equity ownership might be going down, but you're building something so much greater, and the capital and the investors you're bringing in are helping you to kind of get to that greatness. So it's sort of just a natural journey of everybody winning on that journey as you go.
Yeah. Okay, well, I think that's all we've got time for today, unfortunately. And sorry to all of those of you who we didn't get around to answering your questions, but please do send them through to LegalVision or sign up for a free consult at the end. I want to say a huge thank you to Tom for joining us today. I found it really valuable myself, and I'm sure you have as well. I know there's a lot of founders and directors who have joined us today, so I'm sure everything that he's said has been really valuable. You can download our startup manual, so that's a really good founder's guide to all things startup. It includes quite a large section on raising capital and about investors, lots of tips and tricks from investors themselves, but also from founders. There's also sections on IP, protecting IP, all that kind of thing. So really worth a look, even if you just look at certain sections. Do join us for our next webinar that is on the 12th of December to do with signing contracts and what you need to look at before you sign them. I'm sure that will be a good one, but me and Tom won't be there. And yes, please do send through any sign up for a free consult, and we can help answer any questions you have, particularly legal ones. I know we've had some through about IP and not-for-profits and things, so our specialist IP and not-for-profit advisors can help you with those. Yeah, I think that's it for today. Awesome. Here are Tom's details in the case anyone wants to get in touch with Tom and ask him some questions. I'm sure he'd be very pleased to assist as well with any other questions you have for him.
Great.
So thank you very much.
We appreciate it. It's been great speaking to you all. Catch you later.
Thank you.